All right, so we finished the week on a down note, very similar to prior expiration cycles, having some weakness going into expiration. Let's see if we follow suit. In fact, today we're going to kind of look at just how bearish can you be when you're only down 2% off of the highs. You're on a 2% pullback rather than say a 5% intermediate decline or a 10% market sentiment decline, whatever. Can you be strongly bearish and only have dropped over the course of a couple weeks 2% on the S&P 500. So we're going to talk about just how bearish we actually are, at least how bearish people think we are, and in other instances when we've been this bearish from a sentiment standpoint, what kind of move do we expect to come out of that, and how does that relate to these prior expiration cycles pattern, and from a seasonal trend, the kind of weakness we expect to see normally there. So we're going to break all that down in today's video. We're going to take a look at what the risk off move looked like this week, and what really drove it from a different asset class standpoint, and how broad is it? Is it just limited to the Qs, U.S. large cap tech stocks? So we'll take a look at that. Our trade idea is a stock that's in an area where it's been relatively on fire. A lot of people have been talking about this particular sector and how bullish it's been. It doesn't look as bullish as it may appear, so we're going to talk about how to trade one of its components. So let's go ahead and get started. Today is Friday, September the 17th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator like we always do. As you can see, we finished below the 30-day moving average again. The first time we've been this far below, like we've dipped almost 1% below. But again, see, none of these dips were 1%. This was a half 0.58%. That was 0.62%. This one didn't even get below the moving average. So this is the first kind of expiration related dip. This one was a little bit before expiration. We actually got nearly 2% below in May. Of course, since before that we were in March we had a dip that was over 2% below, and then we had 1.33% there. But all these recent expiration related dips that we've had, pretty much the last 3 expiration cycles, were not as low as we got right now. So, but again, the pattern is that they bounce right off of this, and we're getting these bullish patterns again. Light pink shading and a yellow line is typically a pretty bullish pattern. We do have a bearish intermediate trend that's pretty neutral. It's between 60 and 40. It is downward sloping, but relatively neutral, relatively bearish. Obviously, we're not in bullish territory anymore. That's the case as well in the Russell. Even though it did turn up today, the Russell turned up. It is also still below 60. So you have dark green shading here, but not the most bullish patterns, because it's not, we're not back up above 60 and we're relatively flat. That's the Russell 2000. Of course, the NASDAQ is still pretty strongly bullish. Like, we're below 80, but we're easily in bullish territory. Relatively bearish near-term peak that we had here. We'll see where that near-term line ends up going. Remember, this little dip on the near-term line into bearish territory and into oversold territory is and the momentum line being down in bearish territory for so long just kind of shows just how bearish this little pattern has been. It's usually it doesn't come down that far. Of course, the worst market forecast chart of all of them is on the Dow Jones Industrial Average. So you have here again, dark pink shading the red line. We are easily in bearish territory. It's the only one that is in bearish territory here. We are below 20, so we're not only in bearish territory, but we're in the lower reversal zone, so very strong. But you notice again, we're still only less than 1.75% below the 30-day moving average. We got further below the moving average over here during its last intermediate, very, very weak intermediate decline, and that was almost 3%. Over here we got 2%, and of course, when we actually did get the last intermediate decline that it did have was in September and October, and you notice we got 4% and almost 5% below the 30-day moving average there. So we are in intermediate decline mode again, but we're not even, like I said, 1.75%, only 1 2/3% right now. Now let's take a look at the weekly charts for this. Let's go back to SPX here. We'll take a look at the 5-year weekly chart. And you notice, I mean, that's a pretty bearish short-term sentiment. Again, on a weekly basis, mind you. Here, let me get rid of these. These are the lines I drew in regards to that tweet about buying at all-time highs, right? This was the first all-time high post-COVID, and we rallied 32%. And this line is the first all-time high following the financial crisis drop, and the market's been up like over 20% a year for 8 years. So, great, that buying an all-time high is not a bad thing. It's actually usually a pretty darn good thing. But let's go ahead and get rid of these now so you don't get in our way. And so you can see here, very bearish short-term sentiment. Again, we haven't had an extreme drop on the momentum line since June. Again, going into that expiration. But we haven't had this big of a drop on the short-term sentiment combined. We didn't even have this big of a drop during COVID. That kind of shows this how bearish it's been this last couple of weeks here. So let's take a look now at the Dow, because the Dow has been more bearish and you can see also very similar bearish sentiment, very bearish short-term sentiment over the last couple of weeks. Dipping, the intermediate posture is still still strongly in the upper reversal zone, but very bearish. But you notice that, like, despite how bearish these lines are, last time it was this low was over here in the during the fourth quarter 2018. We were well below the 30-week moving average, 11% below the 30-week exponential moving average. We're still 1% above the 30-week exponential moving average on the Dow Jones. The Russell's actually been below it. It's been kind of up and down, up and above. And you notice the Russell 2000 is not showing nearly as strong of a bearish drop, though its intermediate line is below 60. It's the only one whose intermediate posture is not strongly bullish out of all the indexes, again on the weekly chart. And then you can see the short-term sentiment here on the NASDAQ wasn't as bad either. Very strong oversold momentum line, but we don't get the big dip in the near-term line. Now let's take a look at the moving averages here in the long term, the 10 and the 40. Again, there's a few things we look for here for us to be in a bearish posture. Falling PPO, which we have, a negative Hakinyashi candle, which we have. It's the 0.82. See, these two, we're at 0.58 was the biggest one. This one, the biggest one was 1%. So it's a relatively big bearish candle, not as big as we've seen before, but no red arrow. So we didn't get a red arrow over here. We're not getting a red over there. You kind of need that. You need a falling PPO. You need this negative Hakinyashi or bearish Hakinyashi candle, and you need a red arrow to signify that you are in a bearish posture. See, we have that. Remember, the Dow is in its bearish trend. We have that on the Dow, right? We got that last week. We were negative. We were falling PPO, has been falling for a while, and we have this bearish, this red arrow here. Then you look at the Russell 2000, it also got the red arrow again last week. We're back below it. We're still below it now. Negative, falling PPO, negative, bearish Hakinyashi candle. So off this chart, you can see how, we've got some pretty significant bullish convergence going on. Really, it's the SPX that's been the only one that hasn't started to converge, and the NASDAQ. NASDAQ had already converged some before making this move. And again, you can see no red arrow, slightly bearish candle, and barely falling PPO there. Not really starting to converge yet on that. So that's what the long-term charts look like. Let's take a look at the all-encompassing 50-day moving average, right? That's been well documented today. Well, we ended up closing below the 50-day moving average. This is hardly the first time that we've closed below the moving average here. You can see that we actually closed below it over here in June. Back here below, we closed below the 30 and the 17 and the 30 and the 50, all on that same expiration cycle. We closed back above all three lines the first Monday. We closed below the 30 and dipped below the 50 there. We closed back above the 17 and the 30 the very next day. So over here we closed. Let's see, where is this? In the 50-day moving average over here in January, we closed right back above it. Below the 30 and the 50. close right back above the 30 and the 50 the very next day. Close below the 50, close right back above the 50 the very next day. So this is hardly like a unique, I don't know why it's getting so much pub. This is hardly, I mean, we've had multiple drops below the 50-day moving average during this entire intermediate run, and every single time we've come right back above it the very next day. Now, the Dow has already been below the 50. It dropped below there last week, and we've been below it the entire time. In fact, the 8 and the 17-day moving averages and the 30-day is pretty darn close. Another kind of sign here that you are in intermediate pullback mode is the 30-day is crossing below the 50. And you can see that gap is really shrinking. It's not quite below it yet. But, you know, we are bear. The Dow has been. Like, we have not gotten back above the 50. And we're now below that point of control there. And it looks like we are trading in between the gap here between the 50 and the 200-day moving average. Remember, IWM has also already been below the 50 for a good chunk of time. Has been trading between the 50. In fact, it crossed below the 200-day moving average at the August expiration date, 2 days before. We bounced back above it the next day. But we've been below the 50 for a long time. And now you can see, like, even the 30-day crossed below the 50 on the Russell 2000. We are still kind of trading in between the 30 and the 50 and the 8 and 17. Like, you know, they're all converging on each other. We're trading right around them all. We're still above the rising 200-day moving average, but you can see how tenuous that is. A break below the 200-day moving average is a break to very, very low volume levels, and obviously below an important Fibonacci retracement level too, and that 162% extension line that we have from the COVID drop. So the Russell 2000 is actually in the more tenuous position out of all of them, even if it actually had a better day today than most of the indicators. Let's take a look at the SPX. So again, you know, you're not bearish really until you get below 40. See all these other dips? We've dipped below 50 before. All these dips got to 40 but never got through it. We never really dipped below negative 200. We did on this one here in May. Again, came right back up above. Never dropped below 42. So we're not getting that combination of bearishness there. We are closer on the Dow. We did drop below 40 and below 200 on the Dow earlier last week. We're still above 40 and trading around negative 100 right now, so not quite, you know, following through with strong bearishness. And the Russell, you can see, is in neutral territory, and the Nasdaq is actually still relatively bullish. Like, I mean, we're below 100, negative 100, but, you know, not too deeply, and we're still just barely below 50. So, you know, like, we're not bullish anymore, but we're definitely not bearish either. The most bearish we are is in the Dow, and that's even stretching things. On some of these oscillators. Looking at the directional movement index for SPY, that positive index is down to very low levels. You know, these levels down here, if you go over to the left, follow my line along the left, are usually associated with big drops in bearishness. But, you know, the bearish indicator is at 23. I mean, you look at all these different lines over here. It wasn't above 40, but it was close. Over here, it definitely was above 40. So, I mean, it looks, you know, like we're more bearish than we are, and but even then, that's a really low level, and you would expect that especially since we're not that bearish, that bullish indicator will bounce off of these really low levels. Look at the diamonds, same thing. Look at how low the bullish indicator is there. Again, we don't have a strong bearish move, which you would be, you know, again, you look at when we've been below 10, again, usually associated with extreme bearish moves. Not the case this time. So again, it kind of goes to show that it appears we're a lot more bearish than we are on these indexes. There's IWM, again, no trend going on there, and then your Qs, you can see kind of a very similar pattern there. So, you know, it seems like that's what I covered that in our technical analysis class of Market Scholars. If you're one of our subscribers on our site and you haven't watched that class yet, check that out over the weekend. We talked about sentiment. We talked about how bearish the sentiment is right now. We looked at there's actually an example in recent history, mind you, that is very similar to what we're going through now. So is it, you know, are we going to drop from here? Are we going to bounce up from here? That's what my class was all about today. We spent a whole hour looking at some very interesting patterns now that we've actually seen before. I mean, very similar. I know history doesn't repeat, it rhymes, but it's about as close to repeating as we've seen. Setting up an environment, a trading environment that we've actually seen before. So, so again, this might be about as bearish as we get on these indicators in the very short term, considering how extreme some of this sentiment is right now. If you take a look at the Ichimoku cloud and the trend strength, obviously we don't have a trend anymore in the S&P. We're below the blue line for the first time. That's been a relatively bullish pattern before. When you dip below the blue line, we come right back up above it. Lots of examples there. You look at IWM, we're flat, still has been flat, very noisy, no trend at all going on there. You look at the Qs, this is the only one that actually is in a trend right now. You notice it's not below its blue line. It still has an intermediate trend going, moderate trend strength going, excuse me. And then your diamonds, which has actually got a weak bearish trend going right now, where we've been below the blue line for a while. But again, we're not through the cloud. We've been into the cloud, again, multiple times and come off of that. The top of the cloud acts as support, so does the bottom of the cloud. So, we'll see if that ends up being the case here if we follow the same expiration patterns that we've seen recently. All right, now let's look at the intraday chart for today. There's a big gap to the downside, and it actually was a relatively sizable gap. Didn't quite hit the 1 standard deviation mark of 0.5%. We ended up being down 0.58% is where we were down only 0.5%. We didn't drop 2%. We didn't get the jump in volatility, so not the kind of pattern you would see. That would suggest that this is a runaway gap here. We're going to really be bearish here. Again, we've seen this before, right? We saw that here, we saw that here, we saw that here, and look at all the green bars that came after each of those instances. So the pattern would suggest that we'll get a pattern of a string of green bars coming after this one as well if we follow past precedent here. And let's take a look at the 3 green arrow chart, and you can see we have light pink shading on the S&P. We've had light pink shading on the Dow, so that's an intermediate pullback, right? But we're still clear on small cap index and still clear on the Q. So the Q still hasn't gotten a pink bar here like we've had on everything else. So again, it goes to show that we're not in broad intermediate pullback mode yet. And 3 red arrows, we either bounce right off of this or we don't, like the Dow. Every other time we either bounce right off of this or we will continue to the downside. And my expectation is we'll bounce right off of this again. If you take a look at today's volume, 118 million, that's a big amount of volume. It is a quadruple witching, so it was an important expiration cycle. 118 million shares trading hands. Keep in mind the gap here, 447 to the high of 442. So about a 2+ point gap. Add that on to today's range at 4.35. So about 6.5 points of a gap there versus 3.62, and then 118 million. Let's look at those numbers in context. 118 million is off the chart, which again is extreme. 6.5 points is, did I say 6.5? Yeah, 6.5 points is up here. That's relatively extreme. Usually, if you're getting about 4 to 5 point moves, those are sustainable bearish runs. About 80 million shares trading hands. This is 80 to 90 would be kind of a sustainable bearish move that gets these lines moving up without being too extreme. Today's moves seem relatively extreme, especially considering we just haven't been getting very big moves on the S&P 500 here lately. And then finally, let's look at the VIX. The VIX did finish the week high. It's really rare to get a candle on the VIX that finishes near the high of the week. We've had 2 in a row. See, it's pretty darn rare to get it when it's at its highs. So, and we're at resistance at the 90% mark. We've had 2 highs, so I expect that we'll get a couple, at least 1 or 2, maybe red bars on volatility, which means we'll probably drop on volatility towards this 85%, maybe 82.5% mark post expiration. I think the expected bearishness that we expect from a seasonal standpoint after expiration, we might have pulled forward into this particular week. If you take a look at the 2 line versions for this for the VIX here. If you take a look at this, again, we are back up above the 200-day moving average. So again, we typically fall right back down off of this. Now, if we stay above it, that's a different story, right? That's when, again, that we are in, your typical intermediate pullback mode, right? So when you get above the 200-day moving average and you stay there, you get above it and you stay there, you get above it and you stay there. These are all intermediate pullbacks. When you get above it and you stay there, get above it and you stay there. When you get above it and drop right back down on Monday, then again, that's suggesting that we're not quite there yet, and that's my expectation going into this Monday. So what do you think? Do you agree with that? That technical outlook that we just put forward there? Do you disagree? Let me know in the comment section below. Agree or disagree, and what do you think, and why you agree, why you disagree, what charts or indicators are you looking at that suggest why you may be more bullish or more bearish than I am. Share with us what you're seeing down in the comment section. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us you liked our video today and that you want us to do another video again on Monday. Quick way to give us feedback if you like our stuff. If you don't like it, of course, you don't have to click on anything. Also, comment down there. What did you get out of the video today? What stood out to you? What questions or comments do you have? Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, click on this icon right here, Market Outlook Live. That takes you to our Market Outlook live page where I do a live video on these days at 3:30 Eastern Time. We review all the old Market Outlook trades that we've done in prior Market Outlooks to see whether we should stay in them or not. We also put on today's trade already here. You can see all the archives for it down below. So that's the Market Outlook Live. Also, you can see all of our upcoming events that we have here. If you click on View More or if you click on Trading Rooms, you can get to our full calendar. We have a full slate of classes here next week. So make sure you check out, starting with my Q&A session tomorrow morning. Come down here to the bottom, click on this heart, this heart icon eventually when it comes up here. Of course, it takes a long time whenever I'm like waiting for it, but if you click on that heart, it opens up a new tab. Hit that like button right there. Also, come hit this thumbs up icon on the Facebook icon. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers because of all the engagements. That's, and the comments and the shares as well. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with. So we try to make it really easy for you to engage with us here. All right, now let's take a look at what's driving that action today. And look at that big move in the dollar. So that was today's. In fact, that's the only, small caps did finish today stronger, interestingly enough. But initially it was just the dollar. In fact, small caps had two forays into positive territory. After starting in positive territory at the beginning of the day, but not the S&P and the Qs. They really had a big down day, down 1%. Developed market stocks had a down day. Emerging market stocks held up, interestingly enough. Commodities outperformed stocks, but still were down on the day. And gold, despite the dollar's strength, gold was an outperformer relative to bonds and stocks and commodities today too. So even with the dollar strength. If I zoom this out to this entire week to see how how we did here on the week, you'll notice that again, the Qs and S&P, is a down week for them. It was even worse week for gold, which kind of held its drop from yesterday, a big drop yesterday, and then emerging markets, which also had a big drop yesterday, very dollar related. See the dollar jump after being down for most of this week here, and commodities peaking because of that. But the dollar really rallied this last couple of days, and commodities fell, and emerging markets and gold fell hard, and equities fell, but not small caps. Small caps ended up on the week positive. But you had long-term bonds, even long-term bonds pulled back during this seemingly risk-off move. It was pretty much a dollar rally. In fact, just looking at the last 2 days, the 16th and the 17th. There's your strong dollar rally of almost 3/4 or about 3/4%. Everything else down. Developed markets, equity markets, SPY, QQQ. Only small caps are positive. Gold strongly lower. So let's take a look at some of their charts here. Let's take a look at the dollar here, and you notice there's your 2 down days. And again, after yesterday, where we had a big drop back below the 30-day moving average, after being relatively bullish but getting up to that 38% retracement, we've dropped back below the 23% line. We dropped back. We confirmed that drop today. The intermediate line is down below 50. We have bearish short-term sentiment here. We got dark pink shading in a red line again. Like the dollar is bullish right now. It's making a little bit of a bullish run. It would suggest that we are making a run of risk aversion, right? There's your long-term bonds down on the week, but still, the intermediate line is in bullish territory. In fact, if you look at all of the market forecast indicators here, you can see long-term bonds dark green, but yields are dark green and turning higher, interestingly enough. And then you look at some of these other moves, like this is all stocks, not just US, but all stocks here. VT, you can see copper is breaking down. That's a risk on type of strategy. So is silver breaking down pretty hard there. Gold did break down but didn't follow through on that, so a little bit of a safety mode. Crude oil peaking and rolling over a little bit. You can see the euro dropping, which means the dollar is rising. So you can see some risk on type moves going on across different asset classes. Here's the 12 grid for all the major economies out there. Look at all the dark pink shading and red lines we're getting. Developed markets, emerging markets, it doesn't matter. The only really strong areas in the markets right now are Japan and India and Russia out of the major economies. I mean, look at Germany breaking down hard, UK breaking down, Brazil's giving us a cluster, France is breaking down to dark pink shading, Italy. And we are some pretty strong bearish moves. Korea breaking down is a reflection of global economic growth expectations, not very high considering the last 3 months. And then you finally see some light pink shading in the U.S. and Canada, light pink shading and red lines. So we are just barely above 50. So we're close to dark pink shading, and you're also close to dark pink shading there on Canada. I wanted to show you the commodity chart too. Go to the 12 grid on this. So here you can see natural gas, which has made a strong, look at the 57% return over 3 months. Has made a strong move, but you see the long upper shadows. You see that extreme move kind of rolling over. And you can see like silver's dropping hard. Platinum is dropping hard. Copper is rolling over. You've got sugar and corn over here on bearish trends right now. Gold had dropped, but is holding down. Crude oil has peaked and rolled over. Gasoline is on a bearish trend. So it's not necessarily the most strong bullish of moves here. Let's take a look at the currencies as well, the 12 grid for the different currencies that are out there. Here's all your dollar pairs, and you can see the dollar strengthening against all of them, the euro, the pound, and to a smaller extent, the New Zealand dollar and the Australian dollar. Look at the peak. We got an overbought cluster on the dollar against the Swiss franc. You got the dollar rising against the Canadian dollar. You can see how the yen is rising. The euro, the pound, the Australian dollar. In fact, if you look at this week, if I take a look at the comparison for currencies, and just take a look at the last week here. So let me come down to September, and we'll go right there. Go like about 10 minutes. There's a lot more data points on these. Again, you can see the dollar is gained against everybody. The franc the most, the Aussie and the Kiwi the second most, and you can see some of these others over here. You've got the British pound, you've got the Canadian dollar, the Mexican peso, you've got the euro in black, and then again the Japanese yen has also gained against all of these. The Japanese yen also being a safety currency. So pretty much a risk-off week this week across all asset classes. probably more risk off in a week that we've had in quite a while. Again, would suggest that maybe we are more risk off than we probably think. I shared this chart in my technical analysis class. This was the American Association of Individual Investors. Their surveys that come out every week about how bullish or bearish their respondents are. This is one of the biggest drops that we've had. In fact, we typically don't get this drop this far down, without being a really bullish sign. In fact, the RSI dropped below 40. That's a pretty significant drop, very, very fast drop. I tweeted out that not only are investors probably more bearish than they should be, because again, that kind of level is that you see there is go back to, where was that? Over here. That level here of bearishness is usually associated with some pretty big drops. I mean, that's the COVID low point. This is the fourth quarter of 2018 low point. I mean, these are all relatively big drops. But you also notice the consumer sentiment survey came out, and it's not updated on the Fed for whatever reason. They don't have the last one. So the final August reading was 70.3, so barely above 70. The September reading is still at 71 after being expected to be 72. Those numbers are really low. I mean, that's like at this, where my cursor is, that's where 70 is. So you notice we don't typically get to 70 unless we are in recession, right? It's a very, very low figure. This is like pre-1980 when we had pretty high inflation expectation. So, I mean, this is lower. Those are lower figures than what we saw at the COVID low point. So not only are investors probably more bearish than they should be, based on the fact that we're only down 2%, but consumers are also more bearish than they should be, like to the point where these are pretty bullish levels when we get down this point. The markets tend to respond pretty favorably to that. I wanted to show you the skew. The skew is demand for out of the money options, again showing us that we are below the moving average, showing us that we are in pullback mode from that perspective, right? There's lots of things we look at, but from that perspective, we are in pullback mode. We don't have our number updated yet for today. We are we're below the moving average, or barely above zero there. Not necessarily the most bullish sign. The number of stocks below the 200-day moving average. In fact, let me show you this one. The number of stocks below the 200-day moving average, below the 50-day moving average, is below the average, right? Which is typically associated with declines. And in fact, we're almost one standard deviation. That's pretty darn low, especially considering, again, we're only 2% off of all-time highs on the S&P. And something else that stood out to me here today was not necessarily the gamma exposure. The gamma exposure is relatively low. Again, you kind of worry about gamma exposure when it's high, and when it's low, it's actually a really positive sign. So that's a good low point. And then you look at the dark pull index, and you can see it's really high. These are also associated with bounces. They get to this level, you can kind of see, a month later, a couple months later from these levels, it tends to be pretty bullish. So going in the next week, for this to be that high, it's the highest it's been for a long, long time. The highest it was over here. This was in March, and look at the rally we had coming out of that. So, it would suggest that there might be a pretty decent. I don't think we'll get that kind of a move because we still haven't had an exhale yet on the S&P. But I still think that we could be more positive than what this, all these indicators, these extreme indicators that give us a sense of impending doom would suggest. A lot of people think, we're both below the 50-day moving average. And of course, that could all change if on Monday morning we get the three things that we talk about, right? A significant gap of more than, about 0.6%, and then ultimately a drop of 2% or more, and a jump in volatility. So if we get all of that on Monday, then we are in pullback mode, and it will be bearish for a little bit of time. Not fall off a cliff bearish, right? But just bearish for a time. But more than likely, that's not going to be the case. According to past precedent, and according to recent past precedent, more than likely we'll get a good rally coming out of this, and then produce potentially some new all-time highs. Not strong all-time highs, but but more of a bullish bias. Probably still a non-directional move, but a bias to the upside. Not directional enough to get the DMI and things up to really strong bullish levels. This is a grind higher is kind of what I expect after maybe a day or two of strong bullish moves to start us off, kind of like this, to start us off before we get down to small green bars again. All right, that takes you to our trade idea of the day. And energy stocks have been really, like, I guess you could say on fire from a relative standpoint. They've been doing well, though not quite breaking out. So I kind of want to take advantage of their doing well, not being bearish anymore like they were, but also not really breaking out either. So, I mean, if you look at Halliburton here in XLE, strong bullish posture. It's almost above 80, though the near-term line not quite. You can see the near-term sentiment's not really breaking out to suggest that the stock is breaking out. You also don't really see a strong RSI or CCI. They're both at neutral levels still. If you look at the directional movement index, we have a lack of a directional breakout there too. The trend strength indicator doesn't look very strong, very noisy pattern, actually still below the cloud, though we are above the green line, which is above the blue, so bullish pattern there, but not strongly bullish. You look at the Bollinger Band, we are in the middle of the band width, and we are smack dab in the middle of the value area, right at the point of control. So very neutral pattern that you see here. If you look at the long-term chart, let's see right here. You look at the long-term chart, you can see that I mean we are converging. They're like, that's about as much of a convergence as you can possibly get. And then you look at the two-line version here of the MACD and stochastics indicators. We're actually trading between the 50 and the 200-day and the 30-day moving averages, right in that gap, even with strong volume, like not going anywhere. So I like these kinds of stocks that are not going anywhere. I like to do these iron condor spreads. So let's come over and look at selling the 19-17 spread. So sell the 19, buy the 17, find the similar delta over here, sell the 22, buy the 24. Get about 55 cents on the trade. You can see that's ultimately, I think, what we ended up getting was 55 cents on the trade when I put this through in the Market Outlook Live segment. Full position size as earnings comes out right after October expiration. Really good, about $385 return. We're typically going to get around $350 to $400 in that area for these iron condors. You can see the break evens on the chart are right there. So we can go up a little bit, we can come back down and test this lows a little bit again. We can stay right around the point of control for the index and still be just fine. That's kind of the ideal scenario for this trade, and that's why you can see the Bollinger Bandwidth is actually falling here. So that's the ideal setup for this type of strategy, which I think is a pretty relevant strategy to be using in this kind of market environment right now. All right, so that wraps us up for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new threads there with any questions or comments you have about anything I discussed in the video today. Reply to other people's threads, and let's keep this conversation going between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website at marketscholars.com. Hit that like button, that thumbs up icon. To like the video, as well as like us on Twitter and Facebook too. Comment on the video. Have a great rest of your weekend, everybody, and we'll see you all next time.